According to research we at International Fund Investment did, particularly with some of the largest institutional investors in the world, whilst they had criticisms of the fund of hedge fund business, even some of the largest of them were going to continue to allocate to fund of hedge funds, albeit with perhaps more allocations into single manager funds and managed accounts along the way. These are topics we are going to get into today, and really what we're about is to discuss what reforms the investor community, particularly the institutional investor community, want to see from the fund of fund industry.
We're seeing more capital going into hedge funds. Capital is moving faster. Strategies are cyclical, so opportunities come and go. And one example is something like convertible arbitrage, very attractive in the late 90s. By mid-2000 was completely unattractive with zero exposure. After 08, it was hugely attractive again, and therefore we were quite aggressive in getting our exposure from 0 up to 20%. So strategies will come and go, and just because they worked before doesn't mean they work going forward. I talked a little bit about size and growth of funds and how that changes you. That changes people's processes. It changes the universe that they can invest in. If you're running a $10 billion portfolio, whether you're a fund of funds or a single manager, your universe of opportunities automatically shrinks. Either it shrinks or you just keep adding more managers or more stocks, and therefore the quality of what you're adding is being diluted again. So I think size to me has always been an enemy, and even at BNY Mellon we closed our funds when they reached the kind of optimal point, and the salespeople hated it because just at the point where they wanted to sell it and it had a great 3-year track record, we closed the fund because it was the optimal point to protect your investors, not raise more assets.
There is no requirement for a manager to change his performance or how he does things, change his routine. If he doesn't want to give transparency, so be it. And then the investor, as with all other investments, has the ability to vote with his feet. And if he can't get the transparency, and remember that transparency has got to be available for every investor, then he makes the decision as to whether to go along or not. The people who invested in Madoff, an awful lot did know they were investing in Madoff. They had direct managed accounts, and they made the decision because the golf club said it was a great thing to do, the golf club syndicate. Oh no, really, that's what happens, isn't it? That's how these things happen. I've always had a problem with transparency because most people, certainly most investors, when you say transparency, they immediately think of the portfolio. For hedge funds, which by nature should have a short side, having full transparency of the portfolio is going to basically end up by offering an opportunity to squeeze and therefore damage the performance of the manager.
What we're seeing today in terms of the real world is institutions, even the very largest ones, are employing fund of funds in combination with single manager investments. So there's a recognition that even those that want to do it on their own, there is some value to be gained from having a fund of fund alongside the direct allocations. And we're seeing that, as I said, with the largest players, whether it's sovereign funds or public funds, etc.
I think the whole fee proposal and also the problems that fund of funds had in 08 is pushing people towards single managers. And I think what fund of funds are doing are sort of reacting to that and creating this kind of, a bit like us perhaps, this kind of advisory role in the middle to try and meet that demand. And I think all three will continue. I think the fund of funds will continue to get assets, advisory consultants will, and as will single managers direct. I think we can all benefit in different ways. Yeah. So it's very difficult to predict because it's constantly changing from a year ago to today. People are changing what they're doing.
Because I would argue that helping a client with two distress selections for a year is not managing money at all. There's no portfolio concept. There's no construction. It's really just a search service, maybe a bit of monitoring. I'm not saying it's a bad business model, but I'm just saying that is a departure from management, hedge fund portfolio management. something in between. And as I said, there's a gray line, and consultants and other players are coming into the management space. Managers are rebranding themselves as advisors, and so there's a lot of gray area, and the risk of the gray area is that the fees get completely entangled, and nobody really knows what the right fee for the right service is.
I have a question from the States, typically, with all due respect to the person that sent it. I know this person is in the States, but is the litigious US. The question reads, since fund of funds who provide full transparency to certain investors, i.e. a pension fund client, but not to others, i.e. An individual investor, are violating the pari passu rule that says that all shareholders should be treated equally, have any of the fund of fund legal counsel expressed concerns that one day they could be held accountable? You've got a big office in New York.
Absolutely. The answer is yes.
And not just in New York, anywhere.
Yeah.
I mean,
Well, not just the United States, you mean?
Yeah.
You mean?
No, I mean, I'm just anywhere. If you have a company, an investment company, it's a fund of funds, and you give, or any fund, a standalone fund, you give one shareholder information that is important or material, and you don't give it to another, you are contravening company law in practically everywhere except perhaps Nauru.
Well, again,
it's wrong. It's immoral and it's wrong.
There's someone watching this webcast, and I haven't heard from you yet, but you've got a few minutes to email in, that has cheerfully admitted that if it's a certain type of investor, i.e. an institutional investor, it's the same example as I gave earlier, that doesn't have the wherewithal to do anything with the information, and would it be unlikely to do it even if it did have the wherewithal, then they give the transparency. But if it's a private bank in Switzerland, to give a specific example he gave, they won't in certain situations.
Well, I
He's
think
treading on thin ice.
it's wrong.
Yeah.
Well, it happens.
Yeah, but I mean, you've heard me say this before. You know, crooks only become crooks because they've got regulations to break. The fact that it's wrong doesn't mean it's not going to happen.
Well,
People will break laws because they can make money out of it. And it's
yeah.
you know, it's actually unequivocally wrong, isn't it?
It is, from a legal perspective. You
Yeah.
should give investors equal access to information, but they can probably finesse it by having disclosure in their prospectus that says certain institutional
Yeah,
investors may
I
get
know.
more information than
That's-
others. Yeah.
I'm sure that's
Or
what
they have
do.
a different class of share.
Because they're a very respectable fund manager.
If they have a different class of share that's investing in the same portfolio, then you can treat shareholders in different classes differently.
Yeah, can be done.
Yeah.
We have a lot of interest in our fund that invests in Asia. We have a recently launched China fund of funds that's working very well, and that's of interest. As far as Asian investor appetite for fund of funds, it's been quiet the last 2 years, but it's starting to re-emerge.
Yeah.
We have a couple of funds in Asia which are set up by local managers and who have local investors.
Yeah.
Not huge, but I would say if any service provider resigns in odd circumstances and you don't know what they are, then it's certainly a flag. How red it is depends on what you find out. But I would have thought, yes, I mean, it's the same. I know that I think it was Sarbanes-Oxley brought in this thing, auditors have to change every so often because they're getting too familiar. I mean, from my own point of view, with the funds that we administer, we can't wait for the auditors to understand what's going on and get familiar. It makes life a lot easier. But I think that changing administrators is a real hassle, and the administrators really got to, if you excuse the expression, cock it up if they're going to get slung out. Therefore, if they're leaving and they've been let go, then that's one thing, and usually there's an explanation or it's out on the street quite quickly. If they've resigned and there's been some, this is confidential, we're not going to explain why, then I think you probably want to find out why. There's going to have to be something underlying. Now, there were a lot of administrators that effectively sacked funds because they became too small during the downturn, which
That's different.
brings a whole subject on client relationship management. I won't go into that now. But I mean, that's justifiable from the minister's point of view, not necessarily suspicious. But the problem is that if you have something you can't answer the question, people think it's suspicious, and quite often they're right. It's the opposite of it's too good to be true.
Yeah. Anyone got any?
I was just going to say that from our perspective, any change in any of the counterparty relationships, pre-investment, during, or post-investment, once you were in, triggered a complete review, and therefore basically you had to go back and question, okay, why did you change? What was the rationale for the change? Particularly before you go in as well, as sometimes people forget how important that is. There may be a reason why an administrator or an auditor has kind of decided to. The manager may tell you, I decided to change, that auditor wasn't very good, but unless you actually ask the auditor, the issues could be much greater. So you actually have to verify it from both sides.
And do you do that? You would do that?
That's
standard.
Standard. I mean, we've been doing that for years. It's something that, how can you invest if a key counterparty has changed and you don't know why? You're then investing blind, in my opinion.
How often does that happen?
It doesn't happen that often. I mean, the one that happens the most often is we've added a new prime broker to the relationship. That's more common, but change of auditor and administrator is not that common. There were some changes where managers had to go from having a kind of almost like shadow, the rules changed where you could almost have a shadow accounting to kind of full service. That triggered quite a lot of change, because people would move from one administrator that was kind of cheap and did the minimum to now getting a full service. So there was a kind of trend in that, but it can change, and any change requires thorough investigation.
I mean, with prime brokers, when they're adding a prime broker, it's usually because they need more capacity, and that's, as long as the original one's still on the books, then wouldn't be fussed. One of the things we have to do as an administrator, if somebody approaches us to take on their account, is then somehow subtly ask the outgoing administrator for a reference. It can be quite difficult.
I think some people will go over it, others won't. There were, as many as there were in Madoff, there was also a large percentage who weren't for good reason. So I think it's up to the investor to work out the difference between a good fund of funds and a weak one. And I think good investors will do the work and overcome that.
Madoff was a due diligence question. People didn't do their due diligence.
Yeah, but there were many well-known fund of funds that were in there.
Yep.
Oh, sorry.
I suppose my closing comments would be, I'd like to hope that things will be better in the future, but for the last kind of 18 years I'm experienced that it will be we'll be probably back here in 5 years' time debating exactly the same things that we are today.
We'll be out of business.
Hopefully not a Madoff type scenario, because that would be bad, but actually I think we'll still be talking about transparency and all those things. And actually some of the things I've heard either today but also in recent conferences don't give me a lot of hope that people are learning the lessons. I still hear the transparency, what do you do with it, what's the point, and if you get it, you're responsible for it. Well, of course you are, that's your job and that's why you're paid. So I'm hopeful the industry will adapt and evolve, but based on human behaviour and past experience, it probably won't.
Spoken like a good Scotsman. That optimistic view of life you have north of the border up there. Thank you all very much, those of you who are with us online, for following this. I think we've had a wide variety of people, in terms of categories. I know there have been some investors there, from family offices to institutions, and in different parts of the world as well. So thank you, those of you who are still with us. Thank you, those of you who are in the room, for your attention. Thank you, panelists. Thank you to Custom House and to IDS, and hopefully see you for the next one.